Okay, I think we're live. Good evening, chat. Hope everyone's well. Any signs of life we would be most grateful for. And then we'll jump in.
Yeah, it looks good to me.
That's also reassuring.
Yeah, I've got it on second monitor, so.
Okay. Audio, video, colors, all of that kind of voice balance between myself and the duck. Let us know. Works like a peach says, I'm not even going to try to pronounce that name. Sounds European.
Oh, yeah, I can't either.
Exactly. We're just going to give up from the outset. Save ourselves the embarrassment as far as we can, anyway. Okay, looks like we can get started. So, first of all, thank you to Bybit for sponsoring Technical Roundup. You'll see an updated link in the description to check them out while they've got their trading competition going on. So be sure to look at those juicy prize pools there. Although I discussed with Luke on his podcast, Don, how and then sort of one of our mutual friends joined in the conversation on Twitter that the way the prize pool is skewed is really kind of towards the top few teams, basically, right? So structurally, it really incentivizes basically gambling and hoping you hit one out the park and then you kind of sit on it, or even consecutive gamble trades, because there's no kind of participation trophies in this one, right? It's the prize pool, I think, is very much skewed towards pyramid style. So it might
Yeah.
make sense to throw in a kind of YOLO account and pretty much just go for one trade, glory or wrecked. What do you think?
I mean, I don't think, like, these kind of competitions, you don't even win with, like, one trade. Because I've done competitions before, like, in a similar fashion. And even if you kind of nail the top or the bottom, it's not enough.
Yeah.
So what you have to do is, like, let's say Bitcoin tops out and you're in the competition and you, like, times 50 short it, and then it breaks down, and then you close it, and then re-short higher and nail it again, and then you have a chance.
Yeah.
But yeah.
Pretty entertaining, nonetheless. It's always fun to see the number of people that get liquidated, perhaps
Yeah.
understandably. But it's great when the competition is set up that way. It's just a nice cover. Like, no, I was going for the win, bro. No, of course I got liquidated. I wasn't even trying, bro. Yeah, cool. That was just an interesting side note to bring up. Make sure to go check them out. Also, I can see 27 of you are already very high IQ individuals. But if you could go ahead and like the video, support the channel, it'll help us out a lot. A big thank you to, I think 7,000 is the number, subscribers on the channel. That's great. We are grateful for your support, and we'll continue doing what we're doing and more. So today's session, it's casual Fridays. You can probably tell from the intro, not the whole kind of try-hardy presentation thing. Someone on Twitter, and I'm sorry I haven't got your name available, recommended a kind of support resistance explainer type of casual session, because obviously it doesn't make sense for us to explain every single line or box or whatever pretty much every time we fire up the live stream. But it would still be nice to almost give an overview of the framework you use, I use, what we agree, disagree on, etc. Just to kind of give some grounding in terms of where these structures come from. Because trading them is an entire different matter, but just in terms of mapping the market, thanks to that fantastic suggestion, we thought it would be useful to kind of jump in and, again, in a very casual Friday format, because I'm not going to try hard, take over slides, do the teaching thing here. I'm sure many of you have been tortured enough by that on my YouTube channel. So we're in the spirit of Casual Friday. I think it makes sense that, I know we haven't discussed this in advance because we never do. Just kind of maybe so I can flex my full screen tool as well. Do you want to first look at, bring up the Bitcoin chart and then maybe redraw the levels on high time frames and kind of talk about your logic, and I'll interject if I agree, disagree, or just have something to add. What do you think of that kind of format? And chat, let us know as well. I think it'd be a good exercise to kind of in real time sort of thing map a market and attempt to give some sort of rationale or basis for those levels. But I think that's a pretty safe starting point.
Yeah, I can do that. Sounds like an idea. I just have to grab the screen share, right?
Yes. Start presentation or whatever thing. Also, chat, just a moment of appreciation how we've now got the full screen presentation set up. After messing around with the layout, there's no more kind of ton of space occupied by the avatars. The screen share works properly now, so thank you for your feedback on that. It really cured my OCD trying to trying to full screen whoever was presenting. So here we go.
Sick. Yeah, I mean, for me, when I look at the chart, right, this is the monthly chart of Bitcoin, number go up pretty much, right? What I look for, like, I open the chart and I just check it out. Okay, what's going on in the chart, right? And the most important stuff is obviously the highs, the lows, and the consolidations, right? So you have like in this entire thing, I mean, you have this steady uptrend, but like the structures that you can kind of clearly point out are the highs, the lows, and the consolidation. So I look for those, and then I do my box thingy and just map those out. Right, it doesn't have to be like super scientific. Doesn't have to be like in general just super accurate at first. We can always fine tune it later, but I just look at the chart, try to make sense of it, right? Because if you don't really understand what's going on, it's really hard to trade it or like in general analyze the market. So I look for is those three things, and then you can't really like whenever you have like these big candles at the swing highs or swing lows. Like for example, this one, right? You could turn this into a box, right? And say, okay, this is resistance, whatever. But that doesn't really help you much because I mean that's a box of, I mean, how much is that from the bottom to top? 50%, right? Doesn't really make much sense to map it out like that, just because I mean, if you want to trade with that, where do you take the trade? The middle of the box really not that interesting because, oh, and yeah, I forgot to talk about that. Like generally speaking, the highs and the lows of these boxes that I draw are the most important parts. And the box is really only there to signify, okay, this is an area of support. Because really, like when you look at Bitcoin, for example, we have a lot of wicks, we have a lot of kind of weird stuff going on, right? And if you have weird stuff going on, and I think that's in crypto more so than other markets, but it's pretty much the same everywhere. It's important to not get lost in that. And that's why I use boxes, because really what you could also do, you could say, okay, this is the high, or like the high of the consolidation, this is the low, and then use lines, right? You could use the same thing, but then you could get lost in, okay, if we retest there, this is now a resistance and I'm expecting it to go down, right? But that's not the case because that consolidation in general is going to act as support. So this entire area is support, and the top of the box and the bottom of the box are important areas, and they're the ones that are probably going to reverse price, but in general the area is support. And to kind of make that more obvious, and I mean the box kind of style that I use is in parts thanks to Twitter, because it just makes it more obvious what I'm talking about. Because back when I used lines all the time, people really, like, they said, okay, you have lines all over the chart. I don't really understand this. And I was like, okay, how could I make this better for myself and for everyone else? And that's how I got to the box kind of thingy. And I seem to remember, but that might be just me. But back in the day, barely anyone used boxes. And I think nowadays a lot of people do.
I mean, mate, back in the day, I used to get trolled by like bigger accounts for using horizontal lines because it wasn't like an appropriate way to chart because everyone was using trend lines and chart patterns. So I had like less than 10k followers or something like that. And I'd get big accounts like shitting on me. Not gonna name any names, of course. Being like, oh, you know, basically discrediting the horizontal SR method. So yeah, in terms of mapping a market, I can say as a community we've been through quite a few market cycles just on that own, right?
Yeah, I mean it's always changing, right? I mean how people view the market, how people map out their charts. It's kind of like flavor of the month.
Yeah.
I mean I've pretty much stayed with this for pretty much. I mean I've had the horizontal thing pretty much since I started trading. It's been my main focus, but in general, like this kind of style I've had pretty much since 17, I think. Before that was just lines, which works the same way. Like I said, it's just this way it's easier to spot what you're looking for. So yeah, I look at the lows, the highs, and the consolidations, right? In this case, like I said, this isn't really much use, like mapping out this swing high candle because it's too big, right? So I look into areas in the same area that would kind of do the same for me, just like more defined. And in this case, this would do it because this candle is much smaller for one, but also it's been resistance here in the past, and it's probably going to act as support as resistance again if price goes up in it. And if price starts closing back above that, it's probably going to head higher, right? So I would use this one instead of the bigger one. Both work, but as you can see, this just makes it much easier, right?
So the high time frame market structure, like the swing highs and lows, they kind of immediately attract your attention. But then often, if the box or the candle itself is too big to be used as an area, you'll look for nearby structure that still reflects that area of market structure, but the box itself will be more reasonable and more tradable. Is that like a fair summary?
Yeah, and for me, back in the day when I started out using this, I was much more strict with myself, and I just noticed, okay, I was missing trades and I was missing like stuff that I should be having an eye on. Because really, let's face it, like if you have a chart mapped out, you're gonna see things differently than if you don't have it mapped out, right? And if you have like price, like in general areas mapped out, that you kind of that are not really defined. That can affect yourself negatively, in my opinion. Like if you're not careful with what you draw on the chart, it's easy to get lost in what you just drew and then kind of fall for that. So for me, it's been like I've tried to make it more accurate as time goes on, and I found that if I have like too strict rules for how I place my stuff, it gets inaccurate. So I kind of like it is a little bit of eyeballing, a little bit of, okay, this just makes sense. Like for me, this area is just, it just strikes your eye instantly.
Yeah.
So it's just the one thing that I look for. But yeah, it's like, it's not, okay, if this, then that, and then I have a list of like 10 things. It's just kind of evolved in from like, okay, I just map out every swing high, swing low, and then consolidations into, okay, what makes most sense to me, and then I just use that. In this case, it just makes sense because it's more defined. It's the same kind of area. I mean, the starting point of that box is the same. The end point is much closer to price, and as you can see, like that worked pretty well. I mean, in hindsight, anyway, right? But it's the same kind of deal with when you go up in price, right? This area I
you
was
zoom in
looking
a
at,
tiny bit just so we can like
sorry,
that's all good.
Because I'm sitting pretty close to the monitor for some reason, because with the new microphone, dude, like I have my face in the microphone just to make sure that, that everyone
got the professional esports setup, like eyes 2 inches from the monitor, you know.
Terrible, man. But yeah, the same deal with like these areas, right? So these are consolidations in the uptrend, so I'm gonna draw them out generally. So for example, like if I was really trying to get like into like a bottom long, whatever, I would have, back in the day when price went up here, I would have had bids in here in a strong uptrend. You can oftentimes just leave bids into previous consolidation, and that's signified in with this red candle. So I look like whenever you have like a lot of green candles go up, I look at the red candles in between, and those are going to act as support. In this case, we kind of undershot it, right? But that doesn't really make it not support, I think. Like that doesn't make this area as like, okay, now it's useless after we move back up. That's why I bought this back in the day, because of this support, just because I was like, okay, it didn't act as support like the first time it hit it, and then it rallied right back past it. But the moment it broke on the way up was still important, right? You can see that it accelerated from that point onwards. So I knew that that was going to be an interesting area to look at. And I mean, that just comes with experience, right? So, I mean, a lot of this stuff based on experience, based on like just having drawn stuff a lot of the times. I don't think anyone has to like just copy paste whatever I draw on the chart and then just use it. Just make your own. I mean, if you like this kind of stuff and can use it well, I mean, I like it. It's helped me tremendously in mapping out markets. But yeah, it makes sense to kind of look at it with your own eyes and make your own stuff that you can actually trade off of too. And in this case, like this candle isn't too big. It's still too big for a box, I think, but you could say this is resistance, right? And then you wouldn't necessarily trade based off that. So you wouldn't say, okay, we're in the middle of resistance, I'm just gonna short. It's more of a, okay, we're in the area of resistance, I'm gonna look at other time frames. So sometimes you don't have a helper like this and you can't define it more. I mean, you could try to use this, but this candle is way too small, in my opinion. I think I even tried to use it back in the day. But yeah, this candle is too small. So I wouldn't necessarily use it. But yeah, whenever you have something like this, swing high, you can box it out and then look at lower time frames. Okay, do I get like a short time frame, short setup because we're in high time frame resistance, right? And yeah, I mean, I know I'm all over the place. This isn't really scripted, so
yeah, exactly. No, if I could risk trying to summarize some of those points for the audience, it seems to be the case that, and I share much of this, of course. So I'm not just doing your job for you, sort of thing. But starting out in areas of high time frame market structure, which the basic, most simple definition I can think of is where the tops and bottoms have formed on high time frames, right?
yeah.
And in those high time frame areas, there are the technical structures that you can look out for are consolidations, which will act as support or resistance depending on how price reacts above them. But also, as per the thinner box, you can see you can also look for pivots, which is basically using this diagram, smaller candles around those key highs and lows on high time frames, which have already proven to have acted either as support or as resistance or both. That should be plenty to kind of guide you into the levels or areas more precisely, or less precisely, I guess, that are interesting. And then once you have those areas, monthly boxes, weekly boxes, whatever it may be, then comes the act of lower time frame refinement. Maybe you go from those monthly boxes to weekly boxes or even daily levels, or you go from high time frame boxes to low time frame lines. But it's really the act of refinement occurs on lower time frames typically, but you will get your base and kind of where to guide the eye from high time frame levels of market structure for the most part. And then you kind of look for what makes sense at those high time frame levels of market structure, right? Other candles, or like a level that's been both support and resistance, a range, or like a pullback, as you mentioned, with the 4800 level, and you start looking for, I guess, technically compelling structure at those high time frame areas. Is that a somewhat fair, quite long summary?
Yeah, I mean, that works. Yeah, I mean, that's pretty much what I said, just in my whatever way, because I can't put stuff into words.
By the way,
well as you can.
I think Bobble Marin, I've probably butchered his name, says, Don, do you never use Wix to draw boxes?
No, I don't use Wix to draw boxes because, I mean, you could, like, basically, you could say, okay, you have a lot of wicks here. You could draw like your boxes like this and say, okay, this is where price reverses all the time, right? But for me, it's just a little bit more inaccurate. But in general, the reason why I don't like to use wicks in general in the crypto markets or in like most markets is because these wicks are oftentimes, like, for example, this isn't really a representation of what really happened, right? This was just I mean, we were pretty much close to zero at some point down here,
Straight
right?
up, yeah.
Where you didn't really have much buy support anymore. So this wick could have gone like down here, and then you would be like, okay, I can draw like whatever trend line from like this wick to this wick or whatever.
Yeah.
Like, it
Start
doesn't really
coping,
help you at all
basically.
because, yeah, I mean, that wick is just caused because the market's been illiquid, right? Oftentimes, like you
So
get
they're
like
anomalous, right? It's caused by anomalous
yeah,
events. Yeah.
yeah. So the moment you start getting like super high euphoria, a short, like a huge short, gets liquidated, and then he pushes the price up, for example, as high as like until there's asked, really, right? So this could go like to 20. This could have gone to 22, 23. So I mean, I think the wicks in an illiquid market like crypto is, and I mean it's getting less and less illiquid, for at least for Bitcoin. But yeah, it doesn't really make much sense to just like focus on the wicks and the highs, in my opinion. Like I like to focus on, okay, where has most of the trading taken place?
Yeah.
And that just, I mean, it's not necessarily like super accurate when you say, okay, I just box out like the open and the close, but it's more accurate than saying, okay, I'm looking at the highs and the lows. But there's some people that use that really well too. It's just not something that I particularly like. It's just, yeah.
Yeah, I'm kind of, I mean, my personal methodology kind of, I've become more geared towards candle closes over the last like year and a half. I don't even keep track of how long it's been. But it just, I mean, quite simply, I'd love to give you a extremely detailed logical explanation, you know, wicks being anomalies, blah blah blah, whatever, and like where's the bulk of the trading and like candle volume profile. But really it's because I've just had better results and my levels have worked better working using bodies for levels as opposed to wicks. So I you know, I don't want the audience to think that if you use candle kind of opens and closes, you need to be drawing boxes all over the place. I think it applies equally well to just straight up levels, which is what the vast majority of my stuff is. One point you made, which is interesting, and it took me a while to get to, and I'm sure we take it all for granted, but I'm just going to literally draw over your chart, which is cool. Chat, let me know if this works. You can see my screenshot tool, right? You should be able to. Anyway, one thing that Don mentioned about like the 4K area, whatever it was, that he had this consolidation, right? And we broke through it on the way down, and then we broke through it on the way up, and then it was obviously still a valid level when price retested it, right? That's another really important thing with support resistance. If you think about it kind of logically or from first principles, if kind of support resistance worked perfectly every single time, no deviation, no fake out, no overextension through it, just basic highs turn to lows and lows turn to highs, etc., then it would be really hard to lose money, right? Because as soon as you would get something that looks remotely like a level and then you get a close above it, well, that's it, you're like guaranteed money on the long, right? Or if it pulls back, even better, you know, guaranteed even more money. So one reality, even if you know, high time frames I think help filter that effect a lot. I don't know if you agree or not, but I think with the kind of breakouts and crazy failed deviation, overthrow, all of that type of stuff, a remedy to that is using high time frame or higher time frame charts and levels, because those kind of failed breakouts, breakdowns become wicks on that time frame, right? And the high time frame close will be more informative. But generally, something to, you know, get into your mind is that you've seen this diagram a million times from me. You've got level resistance, and then price will kind of break through it, and then if it fails on the pullback, that level is now once again resistance, right? It was resistance here. This has become the failed breakout portion, and then it has resumed its original function as resistance. Again, especially if you're dealing with high time frame levels, for me personally, it takes quite a lot of evidence to disregard the level as washed, and I certainly don't see violent selling kind of on the pullback as the level being insignificant. If anything, I think that kind of proves that it's significant, so I'm happy to treat it as resistance should the market come back into it, right? And I think 6K is a really good example of that on Bitcoin, where, you know, we broke below 6K and then we were coming back into it. I can, again, I'm just superimposing everything on Donald's chart. It's amazing. Whatever, this type of area here, we're not going to be perfect about it. And then when the market was rallying into the level or flying towards it, the technical view was that, you know, we've had yearly support and now we're anticipating the same level to, well, it technically is resistance, right? Because it's broken support that's above market. Now, when price broke above it, again, this is the monthly, so, you know, the break was obviously close to the level itself. You had a lot of analysts, or like, I guess, people on Twitter saying, oh my god, lol, you were saying 6K is going to be resistance, but you can see how the market, you know, how easily the market broke through it. But what they don't realize is they're actually proving my point, because when that level was broken, the market basically doubled in the next like couple of months, right? So if you, that kind of validates the significance of the level, that its break caused a big move, or a failed break at the level caused a big move. So that's kind of something I keep in mind always when dealing with these levels, that just because it's been disregarded or kind of failed breakout above or below doesn't mean it's no longer valid. People ask you, like, so what in that case is a washed level? For me, a washed level is one that loses all price sensitivity. So price will just kind of happily chop and meander through it without kind of volatility or one side being stepped on or anything like that. Just straight up moving sideways through the level, as opposed to, you know, first of all on top of it, then below it, etc. Something like this, where it straight up chops through both sides of the level and there's no kind of price sensitivity, if you want to call it that. That for me is a washed level. So something like this doesn't mean that the level is washed, as we talked about at the 4800 or whatever high time frame box.
Yeah, and I think in that case, like in the example that you just provided, with like price moving in and out of the support resistance level that many times, it often pays to just zoom out a little bit, and then you're gonna see that same area is oftentimes like high time frame support or resistance. And that's why like the close is about to happen or something, and you have low time frames chopping through the low time frame level, and you're like, okay, that level is shit now.
Yeah.
And then you zoom out and you notice that in the same area you actually have a high time frame level, and price is just moving into it, and is actually like just consolidating about like around that high time frame level.
Oh yeah.
So that's something I usually look out for too. Like when you see like price chopping through a level, oftentimes you just need to zoom out, and then you have a clearer picture. But I agree, like that the low time frame level is then washed, because I mean, it doesn't really make much sense to base your trade on a low time frame level that isn't really doing anything for you.
I agree. Another thing I think it's worth being aware of is, I think a common issue. Also, I can see you've got the cheeky battle net at the bottom, Duck. You playing any games after this? What's going on?
Nah, it's just auto started.
Sure. Anyway, let me screen share for a bit. Hold on, I'm gonna cut you off. Present a window. 1 second. Present a window. Actually, can you just turn your thingy off, and I'll just drag my tab down. Is that cool?
That is cool. Yeah. Oh, I nearly pressed like leave the call.
Oh yeah, rage quit.
Yeah, it's over.
Okay.
I don't want to hand it over anymore.
Okay, 1 second. There we go, and boom. Okay, chat, can you see the Bitcoin chart on my screen? Yes, you can, because I'm looking at OBS. Why am I even asking? Yeah, so one common issue that people will have, and you know, I'm flattered by the amount of charts people will kind of send me and ask for my thoughts. I don't think it's the most useful exercise in the world. Like you having a chart and stuff drawn on it, I can't tell you whether you're going to make money from that kind of thing. It's a very limited view into, or look into you as a trader. However, a common thing that can be improved almost amongst all of the, you know, and I struggled with the same thing when I just started off, is that as a beginner, and I think this applies beyond trading, when you learn something new, you want to use it everywhere and apply it everywhere. Do you think that's fair as this kind of general observation,
Yeah.
Doug? Yeah, I mean, you get, you know, you just did a trading course about XYZ and you want to use it like immediately, or find the next trade or the next level setup, you know, divergence or whatever it may be. It's a very common tendency to basically look for stuff that may not be there. And when beginners or developing traders get in the same mindset with like horizontal levels, their charts, as you can imagine, will literally just be absolutely plastered with levels everywhere, right? They'll have like on every time frame, they'll go from the monthly and draw all the levels they think are significant, which is probably going to be most of them, and then the weekly, and then they'll go on the daily, on the 6 hour, the 4 hour, hourly, 15 minute, 5 minute, just to feel safe, right? I think a lot of it has got to do with wanting to have an explanation for everything the market does, which I think is actually a very unhealthy mindset to have, because I think if there's anything that forces you to take a trade, it's when you have every single box, every single price level lined up, and if the market does anything, even if it farts, you're like, oh my god, well I had a box here, something should have happened, you know, I should have been in this trade. Like absolute nonsense. I think you know what I'm referring to, Duck, but you've seen those like diagrams on Twitter of like chart annotations of past price action, right?
Oh, jeez.
And they
Yeah.
will have every single move and every single candlestick being like, okay, yo, here's my technical analysis, like support, resistance, Maruzubu reversal, Ichimoku, clout candle, swing low formed, break, close above, confirmation, bullish, pullback, spiked previous day's low, SFP, pullback, bearish, and it's like, dude, that's absolutely absurd. This it doesn't work that way, right? And it's obviously curve fitting hindsight analysis. So whenever you see charts like that on Twitter, if they're trying to demonstrate an example of like an educational concept, I think that's fine. There's a space for that. I'm sure I've done the same in the past. In fact, I know I have. However, if you're following people who claim that every single move, conveniently in hindsight, was so predictable and had a valid like cause or explanation or something you could grab onto, that's probably a distraction, right? So circling back to the main point, instead of trying to feel safe and have a line everywhere and a level everywhere so that the market is always bouncing off of something or hitting something, I actually think the opposite is far more valuable. When people say do top-down analysis, they don't mean you start from like the monthly or the quarterly and then you map everything, including all the way down to the 5-minute. It comes down to what we said at the very beginning, which is that the reason we do top-down analysis, we start with the high time frames, is because we can pretty reasonably filter out everything else as being at least less significant, if not insignificant, compared to those higher time frames. And that's why the idea of confluence makes sense, right? Where you have not only just a high time frame reason for the level being important, but then when you go down to your more granular time frames, you get further confirmation that the area or level you're looking at actually means something, right? So what am I saying here practically in terms of practical recommendations? I've said this before. I think if you pay attention to the monthly, weekly, and daily time frames, and you orient and you get your levels from those 3 time frames, if you then and kind of delete everything else, right? If let's say you've got a fresh start, go through the monthly, pick the most obvious kind of highest closes, lowest closes type of thing, whatever. I've got a whole video on SR. I probably have to redo it or redo bits of it, but it's still fine for the most part. Do your obvious, and I really mean obvious, like highest close, lowest close, big areas of market structure, swing high, swing low, like those really outstanding levels on high time frames. And then if you're going to dabble on the intraday timeframes, which I think hourly, 4-hour, all of those are fine, only add intraday levels where they are very close to or almost exactly confluent with your high time frame levels, because those are going to be the areas where you'll want to do business, where you expect participation to shift and basically things to happen. Because what you don't want to do is, for example, have high time frame areas very significant, let's say here, then you've got some trashy intraday kind of nothing burger sandwich here, which you think is really important because it makes you sleep better at night, makes you comfortable that you've got a line no matter where price moves. And then you've got another similar level to the top one, like high time frame, confluence, etc., below it. The trades or the areas in which to look for opportunities, again, this is based on beginners, so you could argue, oh, well, you get a continuation setup from here, Yeah, fine, I don't disagree. But if you're a beginner really struggling with mapping a market, the areas where you'll want to do business are obviously the 2 high time frame levels with all the kind of confluence and high time frame backing, etc., etc. The risk of having every single low time frame or lower time frame level on your chart when it doesn't align with high time frame areas is that you'll basically be caught buying air or selling air or just stuck in the middle of the move, middle of a range, when you know that the market is more likely than not the magnet for price is going to come from the higher time frame levels above or below. So if you ever needed a kind of cleansing or a detox guide, I suppose that's the best I can do. It'd be delete everything, do your obvious monthlies, obvious weeklies, obvious dailies, and then if you really want to go down the intraday path to further refine those levels or, for clearer entries or whatever it may be, make sure that those intraday levels are in some way reasonably aligned or confluent with your high time frame levels as well. From like a basic time frame point of view, high time frame levels where you get your high time frame moves. So I think it makes sense, certainly if you're overwhelmed with your market mapping, to focus on those. Let me know if that makes sense, chat. If not, then my bad.
No, I mean, it makes sense. It's just for me, in general, I completely agree. Like, it doesn't make much sense to kind of be in between somewhere. Like, the worst thing that can happen is you have like this beautiful high time frame level, and then you want to trade it, and then you focus on like a low time frame level, and you stop out into the high time frame level, and then you don't take the trade because of it. Like that kind of stuff. I mean, it's happened to everyone, I think, and it
Yes.
just happens when you kind of lose sight of like it's very easy. And I mean, I've done the same, right? I've been sitting in front of the chart, looking at the 5 minute chart for like, I mean, if I count it all up, for days, right, in
Yeah.
my life.
Rip.
And yeah, and then what you do is you focus on it, and you're like, oh, I mean, I think I can see where this is going, whatever. And I mean, you might, right? But then it runs into a high time frame level that you're not focusing on, and then it does something, and you're like, what the fuck? Where did this come from? And in the end, it's coming from a high time frame level that you might have even marked out, but just disregarded in while being stuck in that narrow mindset of looking at like one chart only.
Totally. I think a really good example of that happens a lot is when you're focused on like a micro trend into a high time frame level. And I'll just show an example on my stuff. What you'll see sometimes, or certainly one of my favorite setups to trade, actually. I mean, not favorite setups because it's not a setup. One of my favorite kind of contexts in which to do business is when you've got a high time frame level here, you've got a high time frame level here, you've got like an intraday. I'm gonna make that a different color because we try hard on Technical Roundup. You've got an intraday kind of level here, right? Now, what I really like is when you get a lower time frame trend kind of established either at the base or even through the, first trouble area. So let's say, these are weekly levels, right? Or even daily levels is fine. Like daily. And this is like an M15 or even M5, right? It doesn't matter too much. Oops, that's not good. M5 to M15. Now, what I really like, and this is exactly, I think, what Duck was talking about, people getting caught off guard, is if price comes into this level area for potential reversal. We know it's not as good as the daily levels because it's a lower time frame one, but whatever. And then the market makes its way through it, right? So you get a break, acceptance above, whatever, and then you establish a low time frame trend from this level into the daily level. And so basically you'll see a lot of low time frame traders winning, like support flip to resistance, right? Continuation, breakout, support flip to resistance, continuation, breakout. Maybe it then does a little triangle and then breaks out, right? Then on this final leg, you have to realize that when there's a lot of space between basically the break of FTA and the high time frame level, this type of trading, like trend continuation on lower time frames, makes a lot of sense because you're basically saying price is coming from a high time frame level. It's probably heading, or the high time frame magnet for price is the next level, and there's this intermediate area, the first trouble area, where the market could arguably reverse if it's going to revisit the lows. If it's not going to revisit the lows, good chance it goes to the highs. And again, if this doesn't make any sense, I've got a video on FTA on my channel, go check it out. But anyway, at this point, you've got a break of FTA, right? You've got break above the level, then a higher high, higher low, wherever you think is significant, that's fine. Now, trend continuation entries in this area are really good because, again, you're coming from a high time frame level and you've broken first trouble area. So at that point, this becomes like a really good target, okay? So what you'll see is a lower time frame trend develop. Again, support, resistance, consolidations, breakout, all the good stuff in the world. But because of how nicely the market's been trending up, even though if you're tunnel vision on this trend, you'll miss out on the fact that price has now reached high time frame resistance. So when it first breaks out, like, is this a good continuation trade? Sure. Is this a good continuation trade? Sure. Is this a good continuation trade? Well, no, because at that point you're buying resistance on a high time frame. However, if you don't have that context, like if you don't have this level and the understanding that this lower time frame trend has now hit high time frame resistance, you risk basically buying into it before something like this, the high time frame level, kind of does its job and completely nukes a low time frame trend in one candle. And we've seen that happen in crypto, right? I'm not making this up, Doug. Do you agree that low time frame kind of micro trends have been straight up one candle wiped by high time frame levels at certain instances? Like the grind up and, nuke down, and the reverse of that as well, of course.
I mean, that's pretty much, I think everyone's familiar with it, just because, I mean, that's pretty much where most people get fucked when they margin trade.
Yes.
So I bet everyone that is watching has seen that happen.
So
Where it's like,
yeah.
oh, this looks so good, this looks so good, this looks so good. Oh shit.
Yeah,
And
it's
then
like,
it's
oh, this, you
gone.
know, every single M15 pennant has been breaking out and all the triangles are melting upwards. And then price hits a high time frame level resistance, but people still treat it as the same trend, even though probability wise, now you're, you know, previously you were just long continuation in the middle of nowhere, which is fine, right? If you've got magnets above and below market, but buying resistance, of course, is a totally different matter. So I hope that makes that's kind of helpful from a, I guess, educational point of view as well. If you need help, or if you struggle with market mapping or filtering stuff out, we're not just saying that because it sounds convenient. Oh, high time frame good, low time frame bad. It's definitely not like that. It's just about it's about the context in which these lower time frame trends are occurring. And I know we've both been on the wrong side of trading what we thought were ironclad low time frame levels, and you know, you get stopped out exactly as you mentioned, and then the high time frame level does its job, and you were wrong the whole time. So definitely something to be aware of. I wanted to get your view on something, because this is something that we've discussed a fair bit, and it's quite nuanced. You know, before that, I was going to give I mean, my system is arguably even simpler than Duck's in terms of support resistance explained. Again, I've got a video on the topic, so feel free to go check it out. For me, the vast majority of my levels will come from highest closes before big moves down, and lowest closes before big moves up, or simply turning points in the market. That's about it. So you'll remember, for example, in the daily range, we had highest close here as support and lowest close here as resistance. You can see this preceded a leg up, this preceded a leg down. One question that I kind of want to make a video on, maybe in the future, is, well, what makes a level significant, right? If I'm picking these highest closes, lowest closes, is there any extra filter I can apply when mapping these levels to make sure I've got something significant? So pretty much what makes a level significant. The very short answer to that is, look at what the level achieved, right? So if you've got a high close, right, highest close resistance, and then you look at what happened after that close. Not only was this a volatile leg down, we like that, but you can see that it also broke support or broke market structure. So that makes it extra significant, right? And the same applies for levels of support. If you have a lowest close which led to a rally which made a higher high, that's extra significant, and you know that's really good support because it caused a shift in market structure. I don't know if you use that, Doug. Maybe we all use that subconsciously, but in terms of applying an extra filter to one's levels, I find that levels which shift market structure, or swing highs or swing lows, which are market structure shifting, adds an extra bit of, I don't know, it's a bit of a probability enhancer, in my view, I've found. What do you think on the matter?
Yeah, I mean, I agree. I mean, when I said, like, you look at the chart and then you map out like the highs and the lows, that's kind of what's automatically happening, right? Because you can only see the highs and the lows that actually had like a big impact.
Yeah.
Because there's a bunch of highs and lows on the chart that you could say, okay, this is a high, this is a low, but the only ones that you're gonna see immediately are the ones that actually do something major.
Yes.
And those are the ones that I would want to mark out. So same thing. It kind of happens like just automatically,
Yes.
because really, like, if you look at the chart, the most obvious level is the best, just based on the fact that most people trade it, in my opinion.
Yeah.
Like, you don't want to, like, what I often see is like people get out these fans, scan fans and whatever, right?
Mm-hmm.
And then they get like super smart about it. I mean, I don't really see the reason why I would want to do that, based on the fact that if I only see the line, I'm not going to get any tailwind from other people seeing it.
Yeah.
Because that's the nice part about it, right? When you get a support resistance level, and then you sell into it and price starts going down, people look at it and are like, oh shit, that was resistance, I should have sold. And then they sell too. Or, oh shit, that was support, I should have bought. Or even like during, like when it like starts flash crashing,
Mm-hmm.
and people are like, okay, this is something that I should bid, and then they have their bids with yours. So it's less likely that you get filled and then instantly stopped out. So I like to look for the levels that are obvious. The one thing that you have to keep in mind when you look for obvious levels is that the moment they get invalidated, price moves fast, right?
Mm-hmm.
So when you get like a close above a level, and we've talked about this before, when you're like, okay, if price closes above this level, I'm gonna get out of a short, and then price just zooms past it
Yeah.
and closes like $1,000 above or something. The case why that happens is because a lot of people are looking at the same chart, and a lot of people have the same invalidation. So like they just start closing out, and then you're stuck holding the bag if you're not careful. But in general, like it's still nice, even if you don't want to, like, let's say price moves into resistance and you don't want to short, it's still nice to have that mapped out, because a lot of people are going to step into short, and if they get run over, that's actually a nice place for you to long
It's
into
good fuel,
something.
right?
Yeah, so okay, there's a lot of people that shorted this level because it's so obvious. It got ran over, so maybe I hold my long further than target, for example. That's something that you can keep in mind.
Mm-hmm.
Okay, a lot of people are stuck in a position, or in general, just offside, and then you can abuse that fact sometimes.
Yeah,
Not
yeah.
always, but sometimes.
No, I agree that context matters a lot, and that it's a very important risk, I guess, of trading quote unquote obvious levels. Is that if you're on the wrong side and it gets run over because it's an obvious level, as you said, that's you don't want to be on the wrong side of that. One kind of, again, practical tip that I'm happy to offer, or I guess it just helped me when I was starting out, is if you have no idea where to start, maybe it's a new instrument, maybe it's a new time frame, and you want to get some idea of significance. And again, we talked about high time frame levels of market structure, swing highs, swing lows, etc. But a really kind of useful eye test, if you want some extra help, is just look at the areas where the big and fast moves have come from, right? Not the tiny drips down or kind of chop with nothing all too consequential. Not to say that ranges aren't important, but I certainly, for example, prefer ranges that break violently either way, right? I think that lends extra technical significance. But if you're just like an eyeballing a chart and you haven't got all the kind of screen time in the world, it's just worth looking at wherever the fast moves come from, like the big candles, the real, the origin of the move, or where has volatility really kind of expanded from. And it doesn't matter whether you circle that, draw a line, box that out, you will at least kind of likely be in the right ballpark just by doing business in those areas, or just having your eyes on them. And again, as Duck mentioned, I think my understanding is, with high time frame levels and why they quote unquote work, or why they're attractive to trade, I think there are two narratives that are important to understand. One is, or the first argument, I guess, or explanation, is that you have more people, just more participants with eyes on those levels, as you mentioned. Therefore, that's where the trading volume will be, and if it breaks or if it doesn't break, that'll generate signals for more individuals, which turn into orders in the market, you'd hope, and that's why they work. The second one, of course, is that high time frame participants can't immediately kind of distribute or accumulate their entire clip or position just in one go, right? So from a, I guess, market microstructure point of view, another explanation, if you will, not something I like to dabble in too much, but worth being aware of, another explanation in air quotes for high time frame levels is that they work because the big, large participants who can't just nimbly get in and out those levels, sell support, well, I hope not sell support, but sometimes that happens as well. Buy support, sell resistance, simply because of their size. They cannot do that in just one large clip and a big kind of market order. And that's where you'll see kind of lower time frame distribution at higher time frame levels, and price, we know, can spend days or even weeks at really high time frame levels. And that's kind of an alternative, or perhaps a supplementary explanation as to why they work and why they're important. There's another discussion, which is when it comes to kind of support resistance. I mean, I hope that explainer was helpful. If it did, like the video. Sorry, Duck, I know you don't like that kind of stuff, but here we are. People will ask about low time frame trading and specifically scalping, and whether it's important to have a high time frame context when you're scalping. I think almost everyone we've talked to has been, most of my colleagues that I've spoken to on this matter, it's just about as 50-50 as it gets. Some believe that if you're trading like the actual low time frames, either, I don't know, a tick chart or whatever else, it's really the next rotation you're worried about. And the high time frame levels and context and market structure, all that type of stuff really doesn't play a difference or make a difference or play a part. Whereas, of course, the other half basically argues the opposite, that because you get volatility or significance at high time frame levels, if you're a scalper, you should be even more aware of where those levels are, so you can kind of maybe cut a position earlier or hold on to it for longer if you know a bigger rotation is more likely to come as a result, etc., etc. Do you have any strong views on the matter?
Not really, no.
If you had to pick a side, where would you rest on that? Do you think low time frame trading is it always contextualized by high time frame areas?
I mean, in general, I think high time frame areas help you. So I think they do matter. It's always so hard to kind of say, okay, that this is for sure this, because this could all just be like me imagining things, right? You're just looking at the high time frame
Donald's
levels,
hallucinogenic
like,
den. Yeah.
and you're like, oh shit, we just moved up because we hit high time frame support, but it could have really gone either way. Like, I think high time frame, like for me, high time frame levels do impact like the low time frame stuff. That's why I like to have like my high time frame levels, but I don't really have like the view of, okay, if you like, you should only trade low time frames with the high time frames in mind, because you can really, there's people that I've spoken to that literally just spent their day on the M5 and do nothing else. I think it's harder to do, but I don't think it's necessarily impossible. So yeah, I think it adds confidence, but it doesn't really mean, okay, it's just based on the high time frames. I think it's like a mixture of both. So yeah.
Yeah, I think there's a reason that our colleagues are split 50-50 on the matter.
Yeah.
If I could risk giving a summary to some extent of maybe some of the core things we've talked about, good luck, me. But one is that especially, this is oriented towards kind of beginners or people unfamiliar, start with the high time frames, because that will simply be helpful and put you in the right ballpark if you don't know where to go. High time frame start is very helpful. The second point is regarding those high time frames, you're looking at the highs and lows, right? The swings, the areas of market structure, whatever you want to call them, and specifically, they should stand out and be clear. You shouldn't really be rummaging through the jungle type of thing to find these levels, especially on high time frames. There really won't be that many, so they should be outstanding. The third point is, once you're there, the summary version is kind of look for what makes sense. I think that's maybe a bit reaching, a bit too reaching to be helpful. But as you mentioned, or as you demonstrated on your charts, you can't just box out the whole thing itself. So maybe there's a pivot nearby, or a smaller candle, or a range, or a level, or something there that can provide additional context in that high time frame level of market structure, right? The fourth point would be that once you're there, right, you can refine using lower time frames. So you've gone from high time frame, you've gone to key levels of market structure, you've found something that makes sense, whether it's as simple as kind of a high acting as resistance, the market coming back into it, or whether it's a pre-breakout range, as Duck pointed out, that has been broken, to the upside, and you're expecting it to act as support. Maybe it's a level that's already acted as both support and resistance, and is pretty pivotal, and it jumps out at you as being as such. That's kind of some of the stuff we mean by look for what makes sense. And once you've done that, if you've ended up with a big box, for lack of a better term, or an area that you feel is too suffocating or untradeable, or there's too much going on, the low time frames is where the refinement takes place. Now, whether that's from monthly to weekly, or from weekly to daily, or even daily to intraday, what you want to see generally when you're refining is an area where there's confluence and intraday levels or lower time frame levels generally, which align with higher time frame levels. And then really in terms of kind of the fifth point, in terms of setting expectations, I would say probably, and this is probably the one I learned the hard way, and a lot of my good trading setups have come from this, even though at the expense of losing trades, which is fine. SR isn't perfect, right? You'll have wicks through the levels, you'll have significant overextensions above and below them, you'll have break one side and break the other side, which makes you feel like the level's washed, even though it isn't. I think really screen time I don't know if you agree, but for me, kind of with the SR isn't perfect and observing the market, screen time is the best remedy to that. You just get used to seeing how price acts at resistance, at support, all the different price patterns that take place, and you kind of develop a sixth sense for it. Do you think that's fair at all?
Yeah, I mean, I agree. I mean, I think an important point to that being like that it's not perfect is also that you should get used to like not winning every trade, because you're not gonna win every trade. Like, it's not only okay with time you're gonna be like this god that just does it all right all the time. I mean, with my recent trading, I
Yeah.
mean, it's certain that like I'm at least not perfect. So I mean, there's always going to be like, trading is a probability game, right?
Yeah.
And if you find an edge with support resistance, then use it, but don't expect it to be okay. I'm going to win every trade.
Yes.
So that's like, I think even, I mean, screen time definitely helps. Sometimes you can spot like traps, or you spot something and you're like, okay, this is 100% going up or 100% going down. I mean, you can never be 100% sure, but like, you know the feeling, right?
Yes. Yes.
And then most of the time it does play out that way. But I think it's also, I mean, just get used to losing sometimes, because you're gonna lose.
These are probability enhancers, right? They're nothing more than that. We're not telling you how to read the market. If you understand this, you will always be right and make money. I don't think that's how it works. We're just trying to shift the odds in our favor. And I've put 5.1 to basically reflect that. Levels, chop, fake out, fail, nuke, etc. It's not a flawless or perfect system, and it's certainly not something that will generate pristine trading signals 24/7 for those reasons. And as mentioned, if it really were that easy that you could just draw lines and they always work in a predictable fashion, losing money would pretty much be impossible, right?
Yeah, everyone would be rich.
Exactly.
I mean, if that's, you could just, like, the thing is, if you think about it, if you just had like this rigorous, super rigorous trading system that always works, or like works for years and years and years, that it's really easy to put into words. Someone else is gonna find it, put a bot on it, and then it's gonna decay away, right?
Yes.
So there's always gonna be some sort of, okay, I think this and this and this is gonna happen. And some, okay, I have to interpret the data, data that I'm given. So yeah, I think it's one of the things that I've learned with like being in the market for years. Like, you have to kind of adapt to situations.
Yes.
And I mean, I think like a lot of the crypto people can do that actually really well. Like, the stuff that I've seen with like how people have been trading DeFi, even though like, I mean, most of that stuff is like legitimately a scam. It's still impressive. Like, you see something new come up, and literally like in 3 days, people pull up whatever, trade on the weirdest shit ever, and have it all figured out. I mean, I think that's a really good.
Agree. And we've had to adapt over the years because the market's changed.
Yeah.
So if you're still here and have an account, good for you. I think we've done a decent job with the summary there. You obviously can't see the points because they're on my screenshot thing, but high time frame start, go to your market structure highs and lows. Within those areas, once you're in the ballpark, look for what makes sense. As Duck said, whether that's a range that's been broken out of, or a pivot, or a smaller substructure, all great. Once you've done that, you can refine on the low time frames and look for confluence, while being aware that SR isn't perfect and it'll chop, nuke, etc. Just because you can map a market, that's probably the most important thing, right? Just because you can map a market doesn't mean you can trade it. It's a very dangerous assumption to make that just because you've got the ping pong line go brr type of thing, it's no guarantee of anything, frankly. And a lot of my, as I said, you know, like the clean double close setup that I've got on my YouTube channel, that setup was born out of me eating shit trying to short retests of broken support and long retests of broken resistance. I basically ran out of shovels to throw into my mouth, and I was like, right, something is really kind of going wrong here, because as soon as I get stopped out, the market absolutely moons. So surely there has to be some method or way for me to take advantage of me getting spanked around, right? And so the level that I used ended up being the same, but it went from losing money to making money in the actual trading process. So that's something to have in the back of your mind as well. And I guess point 6 kind of summary for the really base level stuff is, I mean, lowest close, right? Lowest close before a move up. generally areas of support, and then high close before a move down area of resistance. But you should just know that from, again, eyeballing what happens, when a market comes into old highs and or when it comes into old lows, right? So yeah, a bit of a messy kind of diagram, crazy points, awful 400 DPI handwriting here, but I think there's replay value there, and it's nice to be able to talk about these concepts in a slightly more loose way rather than me sitting in my room shouting into a microphone with these slides and re-recording when I say one word wrong. I much prefer it, to be honest, Doug.
Yeah, I mean, I can imagine. I'd go crazy. Like, I don't think I can say one sentence without making a mistake.
Oh,
So
I lost my mind a long time ago. It's fine. I don't feel it. No, but honestly, for some of these videos, right, I would get like four. I remember specifically I had problems with the order flow video, which is an old one, but still, up to date, whatever. I would get like 40 minutes in and then fuck something up and then just sit there in disbelief for about 10-15 seconds before restarting the recording and just pretending like nothing happened, right? Because you still have to be happy, right? I was like, hi guys, new video. Whereas at that point I literally just want to not make any content ever again. But the things we do for the YouTube.
I mean, it's your own fault
It
a
is
little
my own
bit
fault. Yeah,
because you could just edit the
yes,
stuff.
over 3 years I could have learned how to trim or crop or whatever, jump in videos, but instead I put myself through the but hey, it's been good practice.
Yeah, and I think it adds some charm. Is that the
I
word?
hope so. I hope that's the word.
Yeah, I think it adds some charm.
You know what? I think with a good point to round up on, first of all, if you've learned anything, please go ahead and like the video. Be very helpful to us, and thank you again for the new subscriber milestone. We are very grateful. Second of all, we are pretty much a day away. It's the last trading day of the month before the monthly close. I know you'll be updating Twitter and whatever else once it happens, but do you want to give us a quick roundup of what the monthly close is looking like on your end? And you can screen share and give us some insights, because you had one of your recent tweets goes into the consequences of the monthly close, etc. So it'd be nice to give us a preview, assuming nothing mental happens in the next 4 hours.
Yeah, I mean, so for me personally, I mean, this is the monthly picture that I'm looking at, right? So you have resistance in the form of the highest close here, or whatever. It's not the highest close, the highest candle. And I usually, like I said earlier, I use the smaller ones just to make it easier on me. So that was resistance, right? And I was looking forward to, okay, is it going to close above or below? Because if it closes above this entire area, and I mean, you can see how often we've wicked into it, it's going to turn into support. Doesn't mean we can't go down, but it means it's more likely that you're going to find buyers here in this area. And I mean, if we close back above, I could see a move to the next resistance, which is 14K, happen. And then, I mean, if you're super ambitious, you could place bids in that monthly support. If that flips, targeting 14K. Generally speaking, I mean, if it closes below, if it for some reason still dumps in the next few hours, by 1K, I think this entire thing is still resistance, and then you have pretty much this move right now being a stop run. So you would have a lot of people stopped out of the shorts. You have a lot of people FOMO into longs, and then I think we'd head to the next support, which is down at 877, whatever. But I don't it seems less and less likely that we're gonna head down there for the monthly close. But with Bitcoin, you never know, right? It's gonna.
Here's an interesting question. I mean, I agree that the bullish case is fairly straightforward, right? We've got mega monthly swing high. If that gets blasted and it's proven itself as resistance, we just go to the next highest close, right? At 14K. I totally understand that. There's a swing high there as well, which makes sense. There's a lot going on there. Here's, I suppose, a question for you. Is there a bearish case, a high time frame bearish case, if the monthly closes above the red box? Or what would that look like for you?
I mean, it's not necessarily based on the monthly, but if you look at the weekly, I mean, the monthly could close wherever it's right now, right? and you would still have 2 days left on the weekly. And if the weekly closes back below 10.5, I mean, that's already bad news. That makes the weekly look really, really bad. That wouldn't necessarily make me like just looking back on the monthly, that wouldn't necessarily negate the monthly. But if we then started closing back below like 9.9, 9.7, whatever.
So the old range, basically, right?
Yeah, then it's just like a fake, or like sometimes you get like closes above resistance and then still nuke, right?
Yes.
And in this case, I think the weekly, like if it starts moving, it's not necessarily even like a close below 9.7. I think if it's like significantly moves below 9.7 and it doesn't immediately wick up, I think it's still likely that we go to 7.7 and then lower. So that would be the bearish case. Like if you really want to be bearish, even if the monthly is gonna be a bullish close, I think that's the thing to look for. And this is why, like, the bears could make like a really, really good short setup happen here, where you close the weekly below 10.7. So you have weekly, like it's kind of like a bearish weekly close.
So and monthly then close into nuke on the weekly time frame, right?
Yeah, I mean, imagine if this monthly closed at 10K, for example.
Right.
Then you would be mega bearish on the monthly, because that just looks really, really shit. And I mean, most people would agree. And then you look at the weekly, and that would automatically put the weekly close below 10.7 as well, or 10.6. And that would make it look really, really bearish. So if the bears want to step in, they should do it in the next few hours to make it like the most obvious. Like if you want to get some tailwind, I think that's the way to do it. But if it doesn't happen, and if you don't get like sellers into this monthly resistance, which is still a resistance until we close above, I think. Like a lot of people would say, okay, and I got like DMs saying, okay, the monthly resistance is broken like 10 or like 5 days before the monthly close. And in like oftentimes you get these moves above the resistance, and then like 2 or 3 or 4 days before the close actually happens,
it nukes, right? It's the high time frame wick being formed,
and then you're the wick. Yeah, you're like, shit, this broke up, and then you're the wick because you bought into something that actually hasn't closed. So yeah, that's the thing. Like if bears really wants to step in, they would sell it to 10. But I mean, it seems unlikely to happen in the next few hours. But it's Bitcoin, so who knows?
Great.
And then after the monthly's over, look at these two areas. Like, don't want to see it close below 10.6. That would start being worrisome. And then anything trading below like 9.7, yeah, not good.
Sure. Yeah, I don't disagree with any of that. All right, I think we've covered enough. Plenty there to chew on. Thank you all of the people in the audience for tuning in on Casual Friday. I hope you've had a fantastic week, and that your weekend is productive and safe, although I'm sure you'll be just like us, glued watching this thing, perhaps. Thank you to Bybit, of course, for sponsoring Technical Roundup. And as always, like the video, subscribe to the channel, but perhaps most beneficial of all for you, scroll down to the description and go to technicalroundup.com and sign up to our newsletter, which is free, comes out every week. I tried to make it funny, it probably doesn't work, but you can see the good intent behind the attempt at humor. But we do our kind of well-gathered, more careful side of things, not contradicting each other type of thing in the newsletter, so be sure to check that out. We've enjoyed your company as always. Duck, thanks for hanging out, and we will see you all next week.
Bye-bye.
Take care.